Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. This week's video is going to focus on the S&P 500. I'm going to discuss the ASX 200 and commodities in a separate video, and I'll leave a link for that in the description section below. I'm also going to outline a potential scenario, so make sure you stick around for that. As always, this is general commentary and doesn't take your personal situation into account. With all of that said, let's get into our first chart. So we've got the S&P 500 up on the screen, and look, there's been quite a bit of action since my last update. So we saw the S&P 500 fall almost 4% from its high last Friday before rallying again on Monday and Tuesday. And the question now is, was this all there is to the bear market rally, and are we about to head down to new lows? Now, I've got some possibilities that I want to discuss, and to do that, let's jump over to the 4-hourly chart just to get a little bit more detail in the price action. So here we go. We've got, you can see here, you can see the low after the CPI, and what we got from there, we got that big sell-off followed by the strong rally. This was last Friday's price action where the market reversed. Some people thought, well, that was it, the rally's all over and we're going back down to new lows. But then Monday, Tuesday, we came back and made it to a new high for the last couple of weeks. And now we're in a situation where the market's starting to lose ground heading into the Friday's open. Now, I know some viewers would like me to be recording these after the Friday close. Problem is, that is at 6 a.m. Saturday for me, and unfortunately, that's just not a sustainable window to be preparing and releasing these videos because they take quite a while to do. And the thing to remember, though, is I'm looking at this from the overall chart structure, not just one session. So from my perspective, the setups and the possibilities typically don't change based on one day's price action. So just getting back to this chart. So last week I spoke about the potential for a bear market rally, and I said it could potentially last several weeks, and maybe the target for that was around this 3,900 where we've got this resistance. We've got this resistance band coming in at around 3,900. That's a possible target for a bear market rally. And that still remains my base case. So yes, we already have seen a big rally off the low, but I think when you look at the S&P 500 from this August high up at around 4,300, the market still appears, at least to me, and the measures I look at, still seems oversold. And I think the market's inability to attract fresh selling when the CPI came out and we broke below this September low, I think the fact that we didn't get that follow-through selling, it suggests to me that we've at least got an interim low in place, and the market is going to explore what could happen on the upside. It's interesting to look back on this price action from February. So if I just scroll back here, it was around just in here in February. So what happened in February? So we had this low from January. February, we had a sharp sell-off, broke the January low. Market quickly snapped back within a couple of days, not dissimilar to what we've just seen. It was a fast rally. Market put on 7% in just 2 or 3 days. Then it started to lose momentum. Again, not dissimilar to what we're seeing now. In this case, it led to a multi-day decline, got people thinking, look, this is going to go down and make a new low, but then it didn't. It stabilized and went up for an extension of the bear market rally before we then got weaker price action in the months that followed. And now what I'm wondering whether something similar could happen this time, in that we've had a 2-day, not 2-day, we've had probably over about 3 or 4 days, we've had a good move up. Now we're pulling back, and what could form here, what I'm on the lookout for is a potential for a technical pattern called an inverse head and shoulders. So let me draw up a scenario and explain what I'm talking about. So if this, and this is only a possibility, this pattern hasn't even formed out yet. It's just got the makings of this type of pattern. So we draw this in. This is called the neckline. What we have here, this is called the left shoulder. This is potentially the head of the pattern. Now, if a head and shoulders were to form, what would happen? And then also looking at that scenario we saw back from February, if the market were to weaken a bit more over the next few days, maybe Friday into Monday, Tuesday, just a bit of sideways, but not make a new low. Look like it's going to make a new low, but pull up short of making a new low, then rally back towards this resistance point at the neckline and break above it. That's one pathway. That's one potential pathway to getting up towards this resistance at 3,900. So this would be a head and shoulders pattern, a shoulder, a head, and a shoulder. So this pattern hasn't formed as yet. I'm just mapping out one possibility. And the psychology behind these head and shoulders patterns is quite interesting, because how it works is the market will break to a new low, rally back, and then it will roll over and start falling again. And it's during this phase here that people say, well, look, here we go again. We've seen this all before. The market's going off to a new low. They position their portfolios for a fall. They get short. They exit stocks. The market doesn't follow through to a new low, instead goes up, and that triggers the short covering and the re-entries and fuels that rally. So I want to show you an example. I'll show you an example from last year where we had a similar sort of setup in the markets. So this takes us back to October last year. I actually spoke about this at the time on the weekly video. This was during an upward trend, during the big primary upward trend, and this was how a pullback, it was quite a meaningful pullback at the time, concluded. So this is the head and shoulders pattern just in here, where we had the shoulder, we had the head, which made the new low, the rally back up, and then the right shoulder, as the market appeared to be rolling down to retest and break these lows, but it didn't, fell short, started to rally, and onward went the rally. So look, it's a possible pathway for how this could turn into a larger bear market rally. And just something interesting, I'm going to show you how these give you a quick example of how a market can bottom. So say this scenario plays out where we do get the rally, we get this head and shoulders pattern, we do get a continued rally, and if the market were then to continue up to, say, get up towards this trend line before then having a reaction lower, as it's had like three or so times earlier in this decline, chop around for a few months, and then start to retest this trend line, break above it, and then you have a head and shoulders low on a larger time frame. That could potentially be a shoulder, that could be a head, and that could be a shoulder. So this is by no means a prediction as to what's going to happen. This is getting too far ahead of ourselves. We don't have anywhere near enough price action to make this. But it's just interesting to sort of map out possible pathways that markets can travel in. And this is the thing with technical analysis. It doesn't tell you what the market's going to do, but you can look at price action, look at setups, and then that helps you identify possibilities and prepare accordingly. And I think another reason this may be a low point of which at least has some staying power, is due to when you put the Fibonacci's on. You can put the Fibonacci retracements on for this whole advance from the COVID lows to the January highs. This low comes right down to the 50% Fibonacci retracement of this entire advance. Now, the thing with these Fibonacci's is They don't work. They don't work all the time, but lots of people look at them. And so from that perspective, I think they're well worth looking at. So just having such an important low happening at a 50% retracement, it does give some weight to the possibility, I think, of a larger, at least a larger bear market rally than what we've currently seen. So now look, if you're getting some value from this, please hit that like button. Please leave a short comment, say, hey, thanks for the video. It just tells YouTube people are watching, people are engaging. If people do that, well, then I make videos. It really helps me so much if you can please do those things. And now I just want to quickly balance this with what would appear to be relatively positive outlook. I want to balance this with the realities of the situation as they currently are. I think we can't lose sight of the fact that the market does remain in a primary downtrend. We've got this trend line in place. We've got the 50 and the 100 and the 50-day moving averages continue to trend lower, and the market is currently below those moving averages. So that puts the SP 500 in a vulnerable position. So yes, I think there is further rally potential up towards this resistance at around 3,900, but I don't think this is a time to be loading up on stocks by any stretch. I remain mostly in cash. I've got a selection of individual stocks that are showing relative strength, and I've also got a modest position in a SP 500 ETF that I bought just after the CPI reversal a week or so ago. But overall, I remain highly defensive. Just quickly looking at the Nasdaq, you can see that this is still a weak price chart. There's no doubt about it. It hasn't even been able to get to resistance at around 11,600, let alone get above it. And then we look at the Russell 2000, the small cap index, and similar story. It's stuck below resistance at 1,800. It hasn't been able to rebound like the S&P 500. So, and that's also not dissimilar to earlier this year, where the market broke down below a support, tracked sideways, and then broke down again. So this is broken support. It's tracking sideways. There is always a very real risk that it does break lower again, which of course would probably then invalidate the bear market rally theory or thesis in the S&P 500. So look, I think this is a case of continue to tread carefully. It's just not a time for big positions in either direction. So hopefully that was helpful. Look forward to coming back and talking to you next week. Until then, bye for now.